Well, there's the basic question from Stan. And really, Stan, what you're going to look for is just setting up the option criteria the way you want, and then using some of the other criteria that you could use there. So let's go to Bull Put and let's go to search. And in general, what I would tend to look at on the Bull Put Credit Spreads to start with is the default weekly Bull Put series. And this is already established for you. Ernie back-tested these results, and he puts in a description here under Bull Put Spread as to why these criteria worked out best for him. What we found over historical trading is that the shorter term trades, 5-day trades and 7-day trades, aren't really the best. You get a better, we found that because of the losses that you will take eventually, it's usually better to go to the further out in time period because you're able to get a better premium there. So going 8 to 17 days out in time is usually a better result that we've seen in historical testing than trying to force the 5-day or the 3-day trades. Because if you go too short in time, you're not getting enough premium. You will experience a loss. Something is going to go against you. And as you mentioned, the goal is just to establish it so that you don't get too far of a risk. And of course, you also have to be disciplined in the proper position sizing. Now, of course, some of the basic things that we wanted to look for here as far as stock trends go, you can see right there in the main default listings. So the active filters that are being used, of course, naturally, if I'm doing a bull put, I'm looking for a stock that's trading above the 20-day moving average. And we found that looking for stocks where the MACD has crossed over the signal line by at least 3 days, so it's been shown a pronounced uptrend, usually leads to longer-term success. And of course, as always, you need to make sure that if you're trading bull puts or bear calls, that you're avoiding any positions that have an earnings date between now and expiration. Now, related to you had mentioned risk return using the different criteria. Okay? Other things that you could use, if you go to the technicals, you could use Bollinger Bands if you wanted to. You could look for days that the stock has crossed the SMA 20 to be greater than 2 or greater than 3, for example, look for a longer term trend. You could use the number of days the stock's up or down, but I don't think that's really a good long-term indicator for any example. And for the fundamentals, you may want to look for stocks that have a higher price, as you mentioned. You did Netflix. You might not want to look around with some of the $20, $30, $40 stocks. You might want to stay in that sort of $60 range or more. But going back to the options, instead of related to the technicals to help you minimize risk, what you could look at, of course, is doing the strike difference. So making sure you're getting a reasonable net credit that matches your return, but at the same time setting a strike difference. So if I only wanted to see, let's say, 2-point spreads, I'd set that less than 2. And if you wanted to try to collect at least, let's say, 30 cents against that, we can try to do that as well. So let's make our adjustments there and go ahead and see what we're looking at. Oh, okay, so we didn't get anything in our time frame. It's probably because the net credit's too high. Let's go ahead and take that back down to 20 cents, see if we can, that's about a 10% return. That's pretty good, of course. Okay, so right now there's only one that matches that criteria, and it might be just because of some of the technical indicators, still looking for the good probability. So here we have a 2-point spread, the 127 and 125. It's only about a 77% return. So we may want to look higher on that range, but have to lower the net credit. It's only a net credit of about 29 cents, but it is a 17% return. Is that any guarantee it's going to be a profitable position? Not really. But in general, this is what I'm going to look for. I'll typically stay in that 14-day time frame as opposed to the 6 or 7-day time frame myself. I do use the MACD with most of these type of searches, reversed for a bear call spread. If you wanted to go shorter term, of course you could, but you're going to have to lower some of your expectations. For example, if I wanted to just go to next week out, I change my range to 0 to 7. I'll leave the return there, but I'm going to lower my percent range out of the money to maybe less than 2. I'm going to keep the probability at 70 for right now, and I'm going to knock this down to 10 cents maybe for just a 7-day trade on a 2-point spread. That'll probably give us a few more results, even though we're still looking for stocks that are greater than $60. Oh, nothing. How about that? Oh, sorry, folks. You have to go 0 to 8 days if you're looking on Friday for the next Friday expiration. It's 7 days out, but the system doesn't read it as equal to 7. You'd have to look greater than 7. Okay, so there's Facebook again, Apple, URI, United Rentals, and Norfolk Southern. So they're actually 7-day trades, but you notice the premium's lower, 15 cents, so forth, but we have the probability ranges that we're looking for as well. So directly related to your question, adjustments you could make for max return / safety on shorter trades. You could scan for ADX. If you have another system, you would mention using ADX, you could scan for ADX and then remember at any time, if you have a different system where you get a list of stocks that have the ADX that you want, you can create your own personal list and just screen against those. And that, of course, will give you the bull put spreads that match your time frame, your potential return, of course, on the stocks that match that technical criteria that you're looking for. So you can create your own list. Setting the strike difference helps you to establish a smaller trade, a 1-point spread or a 2-point spread, but remember, the real key, of course, is not to overtrade. As I mentioned, you are going to experience losses at one time or another in spread positions in any strategy. Something's just going to move against you that you didn't expect. That's why we avoid earnings. But still, anytime over the weekend, stocks can move against you in a way you expect or don't expect. So the key is here, of course, to make sure that the number of contracts that you're using and the maximum risks, which comes out to be the difference in strike prices minus your net credit, that the total you have invested in the position doesn't represent a large portion of your portfolio. Assume that there is a possibility, there is a possibility that you could take the max loss on any spread position. You could find a trade next week on Monday that's 13 or 14 days out that almost has identical fundamental and technical criteria to Netflix and a similar return and a similar probability, but it could go against you for the full loss. Okay, it's just because something unexpected could happen. So with doing the spreads, when you enter them into your portfolio, you really need to make sure that the monetary risk you're taking probably doesn't represent anything more than maybe 3 or 4% of your total portfolio value. Because if you do take the full loss for an unexpected event, then it only took out maybe 3 or 4% of your total portfolio. And it's a trade-off, of course, because the net credit you're receiving will give you a good premium, a good return, might not have a great effect on your overall portfolio, but I don't want to see you taking 20%, 10% of your portfolio, risking on one spread trade, which could have the probability of going against you. If all 4 of these, or let's say there are even 5 trades, Stan, had similar risk-reward profiles and similar technical and fundamental indicators, if I opened all 5 but something unexpected came out on the 5th one, it went for the max loss, well, I'm technically right 80% of the time, but I'm going to come out of the month with a loss because the 2-point spread loss that we took on the one position is not enough to counter the total 5 net premiums that we took in. Okay, so that's what it can be, and I don't want that to take down my portfolio by 10, 15, or 20% necessarily. Okay, so I recommend using this as a starting point. Use that weekly default search in the bull puts that was back-tested by Ernie for maximum results compared to other technicals. He found that Bollinger Bands actually weren't as reliable as looking for that MACD crossover line with this particular strategy with the other criteria involved. And so over time he found that this one worked a little bit better. And some of the other technicals, including RSI, that he used and he ran iterations of a backtesting with. So I would use this as a starting point. Make changes in the options criteria to match your time frame, net credit requirement, of course probability as well, and your strike difference based on what you'd want to see. Okay, let's go back over here now. Of course, if you have any follow-up questions on that, just let me know. But yeah, that's why we put some of those defaults there, especially for the weekly ones, because we did test those and we ran different iterations and we found which ones that we would best suit our needs as well. Okay. A second question came in from Tony, and I'm going to jot this down. It was sent right before the webinar. This was via email, of course. Tony said, could you please compare the long synthetic split strike to the married put? All right, so if I open a married put on VOD today, I'd buy the stock, and I'd likely buy a July 17 strike put option against the position. He wants to compare it to the synthetic, to buying the April 26 call, selling the 24 put, and then buying the July 27 put as well. Okay. I've had in the past investors try to do the synthetic instead of the married put. Of the 4, I think, that I've had do it over the years, 3 of them went back to just the married put after a 2 or 3 month period. I don't know why, but I know they weren't doing the synthetics anymore. Another one just continued to play synthetics, but in different setups, not using the married put setup. I don't have any explanations as to why. They didn't give me any feedback on it. Their portfolios could have changed. Their investment strategy could have changed. I don't know. All right. So let me just make sure here. I don't have the custom spread selected, so I need to go into the Other Strategies tab. There we go. And let's see, I need to add, let's take out Iron Condor for the moment, and we'll just build these on the fly. I'm going to go ahead and add the custom spreads in. Okay. So for VOD, if I was going to open a position on VOD today as a married put, sorry folks, I'd end up buying the stock, roughly 100 shares, and we're just going to use the main one is that today. Dell, we'll see if we have time. Dell says, will you go over the married put strategy today? This isn't really a full radioactive presentation. This is open to all strategies and all discussions. If we have time at the end, we can discuss it. We're going to take a look a little bit at it right here now as well, but we're not going to go too in-depth into other ideas as well. Okay. So let's see here. We would buy the July. This is how I would maybe open a married put. I'll have to look at the numbers here. Well, the stock trading there, by the 26 put, but I'm going to put this in at midpoint. That's how I always enter my orders. So 278 to 292. It's going to be a 14-point difference, 14-cent difference, excuse me. So we'll put in 285. Nice round number for a midpoint price. Okay, so let's go ahead and submit that. Stock's at 24.63. I might be able to get away with a 25 at a lower risk, but we're going to keep this as the comparison. The standard married put radioactive trading setup means, of course, we're going to buy 100 or 200 or 300 shares of stock, the same number of put options against it. So by buying the stock today at 24.63, buying the July 26 put at 285, I'd have a total investment out of pocket of 27.48. But I'm guaranteed to get 26 back. So the maximum risk is going to be 148, or 5.4% of what I invested into the position. Now, the second layer of position sizing we talk about at radioactive trading is I'd make sure that this monetary risk of 148 does not represent more than 1 to 2% of my total portfolio value. So if I had a $10,000 account, for example, I'd probably only do 100 shares in one put, so the risk of 150 would be right around the 1.5% range. Of course, if we went up to a $20,000 account, I'd probably do 200 shares, and so on and so forth. Okay. Now, although I paid the money for this put option, I'm not down 285 when I open the position, and I'm not down 148 when I open the position. In fact, all I'm risking is the bid-ask spread. I could turn around and sell to close the put and sell to close the stock, and that's all I'm risking. We do have a positive delta on this position, so as the stock moves up, we'll gain a point on the stock, and we'll lose, let's just take a look there, how much would we lose to start with? I'm just going to go to the, I'll go to the option chain real quick. All right, for the July, 26 put, it's a delta of negative 0.6. So as the stock moves up 1 point, I'm only going to give back 60 cents to the put option, and then my delta is going to drop, and if it goes up another point, I'm probably going to give back 50 cents or 54 cents, and so on and so forth. Okay? It has unlimited upside profit potential, a controlled risk, of course, of only 5.4% of what I have invested in the position. Although we invested $27.48, that is the break even, but only at July expiration. I hold the position all the way to expiration, make no adjustments. then I'd need the stock to be trading at 27.48. You see here, even at the halfway point on May 1st, if the stock goes up to $26, we're essentially at break even because the put's not losing one-to-one with the stock. It's retaining most of its time premium. Now, rather than enter this position and put up the cost for the stock, one of the arguments is, why don't you just use the synthetic or any type of synthetic? And of course, a synthetic long stock would be buying a call and selling a put at the same strike usually. It gives you the same risk-reward profile as a stock, but it's using leverage. The question that came in from Tony is related to a split sort of position. So what we're going to do in this case is, instead of buying the stock at 24.63, he wants to look at buying an April 26 call and selling an April 24 put. Okay, so let's go ahead and put that in. We're going to go to April now on a new profit and loss chart, and we want to buy the 26 call. Midpoint there, we're going to put it at 44 cents. So we'd buy one, just for example, at 44 cents. I'm going to sell the 24 put for April. Give me some time here. It's going to be about 65 cents. Okay, so we're going to get a credit for this portion of the split synthetic, in a sense. Okay, so we're going to get in about 21 cents of net credit. And so you see, it's kind of, just this by itself, is kind of a synthetic stock position. We're doing it in a split fashion. The one way to do the synthetic is you'd either do the 24 likely, in other words, you'd buy the April 24 call and sell the 24 put, or we'd buy the 25 call, buy the 25 call and sell the 25 put to get more of a straight line if it's at the same strike. This little bump in the middle here, that just represents the difference between the 24 strike and the 26, and the small net credit there of 21 cents. Naturally, if the stock continues to go up, the long call continues to gain, and the short put is getting further out of the money, so it expires worthless. And if the stock falls, your long call expires worthless, but you may be forced to buy shares of stock at 24, so that loss becomes yours. So now we're going to take this synthetic split synthetic long stock position, and we're going to go ahead and add back in our July 26 put at 285, same as we did with the married put position. Okay, so originally what I should have shown you, of course, and you kind of saw it back on the screen there, but before we added the put in, this by itself did still carry a margin requirement. The long call does not cover the obligation of the short put. So I'd still have to put up the money essentially as a naked put at the 24 strike. Now by buying the put, what have you done? You've essentially created a calendar put spread with an extra long call. Okay, so this portion here really is the calendar put spread. Selling a farther out April 24 put and buying an in-the-money 26 put, that'd be a standard calendar put. And then you added a long call to it, or you did the synthetic split. Now, why would I personally not do this? Well, number one, it's a lower risk of 113. I understand that. But now we're using margin. That's 42% of what I invested. Okay, so I have to be careful. My monetary requirement here, the debit, is 265. Remember, it would have cost me $2,700 and I think $80 or so, $40, I can't remember. Let's just call it $27.85 to do the married put. But again, if I had a $2,000 account, I probably would have only done 200 shares and 2 puts and be risking only 5.4% on the position, or roughly about 1.5% of my total portfolio value. First off, and I don't need to be obvious, we've got a 10-to-1 monetary ratio. A lot of people say, well, that's fantastic. That's much better trade because you're using a tenth of the profit. Yes, but if you said, well, Mike's investing $27.85, I'm going to be smart and do this leverage, and I'm going to do 4 contracts on the position, so you still only be using about $1,000 or just under $1,000. You're still using half, but now you're going to be risking $450 roughly, or close to it. Somewhere between $450 and $460 monetarily. which in a $20,000 account is pushing you above that 2% line. Can you lose the full amount on this position? Well, it's rare. It has to be right there at 26. Okay, that is a subtle difference here. The stock would have to be trading at 26 for you to do the loss. You're bullish on this stock, though. Anytime, here's where I really don't like this position. Yes, the bottom risk is lower, down to here. The 113 only occurs at this point. When I open a married put, it's because my expectation is the stock's going to move up 3 to 6% or so in the first 20 to 30 days, or 20 to 40 days. All right, so let's just say 5%. Well, this would put the stock right up at 25.63. On the married put, I'm going to have a gain. With the synthetic, you're going to be at a loss. You're going to be in your loss zone here from about 24 to about 28, even at the halfway point. It's a small loss there, but you're entering in the loss zone where I'm seeing a profit. This isn't quite yet a positive delta to the upside until the position is countered, okay, until the two options are countered. What do I mean by that? Okay. I'm sorry, I had to look at a question there. Oh, okay, yeah, Ashwin just kind of, I was looking through this here as well. We're going to take a look at that in just a minute here. Two things. Okay, so Ashwin said one of the hard things to do with the synthetic is getting the delta to match the same, unless you use the same strikes. It really is. Again, let's go to the option chain for Ashwin's second question here in relation to this. And our delta of our April, we got to go there first. Sorry, the delta of the, I'm in calls. So the delta of the April 26 call is going to be a positive 0.29. Let's go to the puts for April. The 24 put has a delta of 0.40. Okay, so it's close. So what does that mean? Well, this is a negative delta for the put, but remember, we're selling it, so that's a positive delta to the upside in a sense for us when we sell the put. So with the delta, let me go, and what was January? Is it 0.6? July we bought was 0.6. Okay, so let me jot that down. Let's go back. So on our synthetic, looking at the three legs again, the delta of the 26 call is 0.29, which is our positive. Okay, but the delta of the 24 put is a negative 0.4, but since we sold it, that actually becomes sort of a positive. As the stock moves up, this is not going to gain 40 cents. It's going to, lose 40 cents of its value essentially for every dollar the stock goes up. But it gets to zero. It doesn't keep gaining in that fashion. That's where that delta goes out the window. And then this is a delta of negative 0.6. So looking at it, you can say the delta is plus 0.69, so that for every dollar, is plus 0.69 for the calls and minus 0.6 for the long put, so it comes out to 0.09. Well, that's not really true because remember, this isn't a delta here. This negative of a negative 0.40, the delta is going to zero. The plus is not increasing. The plus on the long call is only. So it takes a while for that to recover before you start getting back into the positive zone. That's why I don't like this position, because usually my target is going to be in this range for a 20 to 40 day or even maybe a 60-day position, and that's not doing me any good with this kind of synthetic setup. Whereas with this position here, if in, let's go just 20 days out, my apologies here, we'll go to 223. And, we'll just do the, say the stock's trading at 25. That's probably be higher than that. But let's call it 25.50. Okay. Let's see that skew there where it starts to rise up on 223. I have a small profit here at 24. But remember, you're getting closer to the max loss here on the other position, or at the halfway point would be about here, but we're looking at a profit here. We don't see the profit till the stock moves up further. So what is the trade-off here? You're using leverage with the synthetic. You have to be disciplined because leverage could equal to over trading. We saw that the synthetic position has a lower risk to the downside, only about half, a third almost, of what we had with the married put with less capital. But in our target range for where we think the stock is, that's where the max loss occurs to where our profit would be. And it takes longer for this position to realize a profit to the upside. Now true, the risk is lower, but you need it to start moving up further to start getting to that profit position. That's why I'm not a fan of using the synthetics in most cases, especially the split and set synthetics added to that. You get a little profit bubble here, low risk here, but you need more area in here for a profit, and you don't get the advantage, as Ashwin mentioned and followed up with, of the positive delta. Okay? Yeah, and the married put, Ashwin, you're right. I had a plus 40 delta net to the upside, which would only increase as the stock continued to move up. It would go from positive 40 delta to a 50 to a 60 and so forth. Okay? In the synthetic, you're only at the 9. Now, Tony asks, there's no margin requirement here. That's right. There's no margin requirement when you do this synthetic because the put is in the money. Now, if I bought the July 23 put, I'd have to put up $1 to cover it. But it's still a net debit because the cost of the long put. Right? But that's leverage. That's the leverage. You're using 1/10 essentially of the capital I put into the married put, but you're risking 42.8% of what you could invest in the position. So if you decide to do 4, 5, or 6 contracts, investing $1,200, $1,300, $1,400, you still might be using half of what I'm using. But you're going to be risking 5, 6, 7 times. Now, yes, it's in the peak here, but that would be in my target range for opening a married put. I'm not saying this is a bad trade. I'm saying that this risk-reward profile does not agree with what I want to do when I open a married put. It doesn't match my targets for the position in the stock I would have selected to enter the married put because I'd be putting myself in a loss, where in the married put I'd have a gain. Okay? So that's what I think of when I look at the two synthetics side by side. Okay? You want to look at the delta, you want to make sure you don't overtrade, but it's sort of a different play. You're looking for much more reasonable upside. Yes, you've given yourself more time here, Tony, I see that. That's not outside of the range here. And I like the fact that these ratio back spreads, ratio call spreads, this is sort of a, I wouldn't call it a ratio call spread, but you get a similar risk-reward profile with sort of a ratio back spread as well, using just puts or just calls, depending on how you set it up. But as a synthetic with the married put, the synthetic split with the married put, this doesn't match my goals for my targets for a married put position. I appreciate the risk is low to the downside, but you need a much more bigger move in most cases because of the delta that we just pointed out. Thank you, Ashwin, for reminding me to point that out as well. Okay, let's see here. I had another question that came in. Okay. Earlier, when we were talking about the credit spreads, the Bull Put credit spreads and so forth, Daniel asked a question. He says, what do you use as stop criteria on credit spreads? For instance, on a 5% OTM Bull Put spread, there's a 5-point spread, 50 net credit, you have a 450 max risk. But what stop strategy we might have back tested? Okay. I am a fan in credit spreads, and we've back tested this in most examples, okay, in most of the default searches that we went through. For the covered call and the long put, I apologize, not the long put, for the naked put, excuse me, the covered calls and the naked put, the picks of the day there, Ernie shows you what he's back tested. But as a general rule, here's somewhere that you can check out, Daniel, later on this weekend. Okay, when you have the time. I'm not going to have a chance to go over all of them, but I'll outline them for you, and you'll be able to see it. If you go to, wow. If you go to powerop.com/webinars.asp, this is the free webinars page. Take a look at the options strategies category. And in the options strategies category, scroll down here from September 27, 2015, you'll see a section, a webinar for managing your Bull Put credit spreads. This is a public page. You don't need to be logged in. And we talk about here the 7 ways to manage a Bull Put spread as well as trigger points to use to help limit losses. There's also one on just managing your spread positions. This one here focuses on examples of the Bull Put credit spread Further up, there's a full webinar on managing your bear call credit spreads, similar 7 ways that we look to do that with the trigger points in mind. Okay, let's take your trade, your sample trade. Let's go back into our custom spread tool. I'm not going to use VOD. I think we're going to use Netflix, for example. So with the question that came in earlier for the Netflix bull put spread. Let's go 2 weeks out, sir. Daniel will go 2 weeks out here to February 17th. We'll use a 5-point spread. I don't guarantee we're going to get a 50-cent net credit, but I'll try to get close to it. Let's just do a 135, 130. So we're going to get about 93 cents here, and we're going to get better than that. We're going to get about 60 cents, but we're going to fudge the numbers to show us a 50-cent net credit, Daniel. Okay? All right. So let's sell to open the 1 here for $1. And let's say we got a bad price on this and it was at 50. I know those aren't the real prices. We're just going to keep the math simple for our simulated example. Okay, so here you get your 50-cent net credit, comes out to your 11.1% return. Your monetary risk is $450. The stock fell below 130. You'd have to cover the 5-point difference in strike prices, but we keep the credit regardless. Okay, and as a really quick view, I'm just going to go to the research tool here for our put option that we're selling. Okay, there we go. And we're 3.7% of the money. Not too much, I know. It's 3.7% out of the money. You had mentioned 5%, but we'll take the 3.7% out of the money. Excuse me, folks. We've got a probability 76.6%. Okay, then we're just jotting these numbers down here as that might be something you would use. And of course, we'll talk. We didn't look at the stock in depth on this, but we'll talk about that as well. So before we talk even about management techniques, which you can watch in that webinar, what would my trigger points be? If I open this position for a 2-week out trade or more, if it's only a 1-week out or a 10-day out trade, I might reduce this. But the first thing I look at is the stock price itself in relation to my short put. My number 1 rule is if the stock falls to within, and it's not a hard rule, as far as it's a stop point for me, I'll close the position out. But the first idea is to say that if the stock falls to within 1% of my short put strike price, I may look to adjust the position. Okay? I probably would have originally looked for positions like you had mentioned, maybe if it was a month out in time, where we looked for the short put to be 5% out of the money at the start. You wouldn't open a position if it's only 1% or maybe even 1.5%. If you're looking at a 3-week or 4-week trade, I might go to 1.5% as a stop or as a trigger to make an adjustment. Now, a lot of times we know the stocks can fall below the puts and then move back up. But in this case, I don't want to take that chance with the spread position. So the first target is to be 1 to 1.5%. With my strike price at 135, well, $1.35 is 1%, so I'd be at about 136.35. Okay, so if the stock drops to about 136.35 within 1% of my 135 strike price, I may look to manage the position. All right, so that's the 1% rule based on the short option, or 1.5 based on your time frame. Number 2. When I looked for this position, I probably looked for a stock that was above the SMA 20 or the SMA 50. Or you might have used ones where the MACD had just crossed over the signal line. Or you might have used Bollinger Bands. Well, any technical indicators you use, you should do the reverse. A trigger point should be if your stock falls now below, I'm sorry, I reversed that, but you get the idea. If the stock now falls below the 20-day or moving average, the bull trend turned to a bear trend. Or if the MACD crosses back over the signal line and starts to pull down, that would be another indicator. Or if you use Bollinger Bands, the Bollinger Bands turn from positive to negative. That might be another indicator that you would use. I have investors that you'd like to use the net credit. I personally don't, but it can be valuable. Your max return is 50 cents. If you don't want to lose more than 3 times of what your max or 4 times of what your max is, you'd set a stop to liquidate this position if it was a debit of 150 or higher. Okay, or right, if it starts to move above 150, that might be your trigger point. based on your net credit, if the debit to close exceeds $150 or $2, twice that amount, you may look to adjust it. Another trigger point that investors use is similar to this, but they take a 50% rule, meaning that they would put it at $225. So if the debit to close the position hits $225, 50% of the max loss, they'd look to close the position. Some of you, instead of using probability, or even if you're using probability, you might also use delta or the probability. So if I open this position, and we saw that short put had a 76.6% probability above, and we had a, I didn't write down the delta, my apologies, but it's probably the reverse of that. So our short option delta was probably about negative, let's call it 2.5, okay, negative 0.25. Let's say the positions you opened, your requirement is it has to have a delta of negative 0.3 or less. Well, that could be a trigger point too. If the delta of your short option moves up to 0.4 or 0.45, right, half of that delta requirement, you might look to close it. If the probability drops below 60, or some range there, maybe even 55, I'd probably use 60, but you might go a little bit lower. So you opened it when it had a 76.6% probability, but if it drops to, let's say, 60 or 55, that might be your other trigger point. My main two are here personally, and one of them is that 1% rule. I'm going to look to close the position if the stock falls to within 1% of my short put. Not really close it, I'm going to look to see if I need to manage it. And of course, the other one is going to be whatever technical indicators I used, simple moving average or MACD. If any of those two reverse, I'm going to look to alter the position, see if I need to move this down. And of course, with Netflix, what are some of the adjustments? Well, it's a 14-day out trade, so in the first 7 days the stock hits that, I might buy to close my 135 and then maybe sell to open the 132 or the 133 and leave the 130 there. If it still results in a profit, give myself a little bit more protection, a little bit lower delta, better probability now in this case, hopefully, from where we are now that the stock has hit that trigger point. But that webinar that we showed you, that discusses the 7 ways to manage it when these triggers are hit. Typically, I focus here. I have investors that use the monetary amount or the closing amount, and this here, the delta and probability, I'd say is pretty similar to looking at these values here. Because if the stock falls to that 1% range, my delta is probably going to be up at around 0.45, 0.40. So that probably hit that trigger. The probability would probably be around 65, maybe 60. So both triggers sort of work together. The delta, the probability in the 1% rule and the delta in the 1% rule as well. Okay, so that's what I look for in those also. Those are some of the trigger points you would use. Okay, sorry, I was just reading a question very quickly. Valan said, is it wise to leg into a collar trade with a covered call short term where the stock is declining? I don't think so. I don't know if I really understand your question. If I open a standard collar, which has a similar risk-reward profile to the Bull Put Credit Spread, we'll keep with this with Netflix. If I was to open what's called a standard collar position, not a radioactive trade, just a standard collar position, I'm going to buy 100 shares in Netflix. More than likely, I'm going to build this on the fly. I'm selling the 142. We're going to get $2 for that. Probably going to buy the I want to go with the 135, but I'm going to stick with the 137. I'm going to keep it. No, I'm not. I'm going to go back to the 135. I apologize. Let's see if I get the numbers I want for what I call standard collar. All right, so we've bought the stock, selling an out-of-the-money 142 call for appreciation. I said we're going to get $2 for that based on the bid-ask spread. And our 135 put, let's go midpoint there, 93 cents. Okay, so I'm taking about half of the capital away, premium away for buying the put. It's what I call a standard collar. I still do it with some of my portfolio. I'd go deeper. Sorry, I'd probably go lower than this on the position. It's a good risk-reward ratio, 3 to 2. 2% in 14 days if the stock goes above 140 and 3%, I'm sorry, 142 and 3% maximum risk. I'd probably increase this. I usually look for around a ratio on my standard collars of about 2.5 to roughly, I'm sorry, a return of 2.5 to roughly a risk of around 4.5 to 5%. I don't like to go more than 2 to 1 if possible. Okay, so your question is, why select into the collar with a covered call short term when the stock is declining? Okay, so I think you might be asking about a radioactive trade, but in this case, when I enter a standard collar, I do everything at once, so I lock in the risk reward that I want. If I'm in a standard radioactive trade and the stock is declining, no, I do not want to sell a call because the only good premium I can get is the one that's below the strike price, and that's going to hurt my position. I'm going to go to the portfolio real quick. Oh, well, that's not going to do us any good. Let's just go back to the custom spread tool. And let's see here. Amazon closed today at 8:10.20. I believe it was at about 8:30 2 days ago before earnings. So I'm going to put it on July 8:50. I'm going to put the price at $62. And we were going to buy this, so what did I say, 840, 850? Oh, okay, let's go 840. Okay, so this is going to be, is this our high-risk position? Well, it would help if I put in 100 shares, huh, folks? There we go. All right. So we put in 100 shares. It's a good risk. I mean, this is, let's just focus on the risk. 5.8% of what we invested. Let's ignore the fact that it's a $90,000 trade at this point. Yes, I'm with you guys. I would do a synthetic or a calendar spread or a leap call instead of the married put on Amazon because, well, I don't have $90,000 in my account to trade that position. So I would maybe do it as a different trade. I didn't do it on Amazon. I did it on another higher price stock. I did a long strangle approaching earnings and put out about $1,100 for a couple contracts. So anyway, the stock's fallen now to 810. You still have the 850 put. Stock's down at 810. You say, okay, well, I'm going to fix this. The stock is declining. My way to fix it is I'm going to look out to February. I'm going to sell an 820 or 825 call. Okay, so the stock's fallen. I'm going to sell an 825 call for about 610. The stock's at 810, so we're 15 points out of the money on an $800 stock. But we're probably going to get 630 for this position. Okay, so we're trying to hedge some of the loss here. A tenth of it. Tenth of what we paid there. So the reason I don't like doing that is because you have to take in the total cost. Let's say instead of an $800 stock, this was an $84 stock, and our cost basis was $89.57. And the stock fell to $81, but we're still holding the 85 put. Now, the problem with selling the 82.50 call is that you cap the gain to the upside. So if this drop has happened, this sudden drop from earnings has happened, and the stock starts to recover and move back, if it moves back quickly, we don't have anything to show for anything. That's the risk of trying to chase the stock down when you have a higher strike put and you're trying to roll it down to minimize the risk. Okay, that's where it gets dangerous because you give yourself no real chance for profit on this position. What I could do here that might be even better, well, there's my 825 call there. Before we sold the 825 call now, let's say I sold my July 850, bought an 825. And we're just going to use the natural bid and ask here. So I'm going to close this and move my put down. I'm going to increase my risk. I realized that. I took my risk up to 7.2% by moving the put down. Don't think it's really going to give us what we want, but what about now that I've lowered the strike, I've lowered the cost basis, now maybe sell, let's get in the 800s, Mike, 825 for 630. Okay? So now we lower some of the cost basis by manipulating the put option in our favor. Only got about $7 back from it, not great. Okay, but you see now you're getting a little bit closer. It's not as deep of a loss here, but it's still not something I would do. I don't want to see it all in the loss zone. That's why I don't chase the stock down by selling a call at a lower strike price, because I have had that happen before. About a year ago, 2 years ago, I was in a position that went up as I expected in a married put. I rolled my 30 put up to the 33 and then I think up to the 35. And as stock hit 35, it pulled right back to $31 and it stayed there for about 2 months. No, it was 40 days. Well, I got bored with it. I was trading around 32. I'm holding the 35 put. My cost basis is around 34.50. I'm looking at a small loss here. So I decided to take a chance and sell a 20-day out 32.5 call, generate about $1 premium. Over the weekend, something that could not be told by any stock chart, any news, any information such as that, infusion of capital from an outside venture came in, stock jumped up to 38. I took a 6-point loss because I had sold the 32.5 call. I capped any positive delta I had by chasing it down. The unexpected happened, and I'm sorry, it's 36. Stock gapped up to 36, but when it did that, it put my 35 put out of the money. Would have cost me $5.50 to buy to close the 32.50 call, which had 20 days left, and I was stuck with a 6-point loss where I would have had a 5-point gain had I not sold the call and not chased it down. I didn't know that was going to happen, but that's the risk that can happen. Tony, let me see here. Let me look at Tony's question again. I think I have a couple other questions here. There's the question you asked, Tony. I'm going to go over briefly, but I'm not going to be able to get in depth to it because there's so much to do there on that position, the comparison there. Okay. Okay. Oh, Dwight, I just kind of showed you. Dwight, I'm sorry, let me go back here. Based on what we were just showing, Dwight asked what adjustment might you consider doing. The stock fell in that position, I'd consider 2 things. I showed rolling down the put to look for a better position. I do combination of income methods, maybe 6 and 9, 6 and 1 for those of you in the blueprint. Let's see. There's a couple of other things I do that are mentioned in the blueprint. Valon, Valon followed up with married put to collar legging in. I'm not sure I understand what you mean by that. I thought I just showed that. So if you have a clarification of what you want to see, let me know because I'm not clear what you're asking for. Okay. Oh, okay. I can't answer this question for you, Scott. I'm sorry. Scott asked a very well thought out question. If any of you have thoughts on this, you can chime in. I'm not going to answer this. I already fried my brain this week doing my own taxes. Just kidding. But Scott asks, my question has to do with margin. I understand the risk of margin within an account and to be careful. My question has to do with if I want to trade 40K of my cash, $40,000, I have access to a credit card offer at 0% for 1 year for $10,000. That would make capital at 50K. Do you consider that a margin issue? I only trade, honestly, to me a margin is if you're borrowing money, even though you're saying 0%, but you're borrowing money that you don't really have and you might have to pay back. You got to be very careful with the strategy that you use in that case. That's the best way I can answer that. The margin I consider is when I do a bull put spread that we showed earlier. If I'm collecting 50 cents against a 5-point spread, I have to put up $4.50 to cover the trade. That's the margin I use. I never borrow to enter positions, even on the standard collars. The only time I've ever borrowed on margin or left a trade on margin is after I've bulletproofed a radioactive trade or one of my standard collars that I rolled and it had no risk to the downside. I will take the capital out of that position if it's in my cash account. Okay, it's sort of called portfolio margin. I can take the cash out of that and play with other trades because even if it falls against me, I can't lose any of the capital. It's already protected. I've done that before. But what conservative approach would you take with your trades? You've seen them already. Married puts and collars, that's the answer. That's the most conservative things that you can do with options because of the single-digit risk, okay, that I take. That's would it be a good choice to have a bit of margin in the initial funding? I don't think so. I wouldn't do it. I also wouldn't use margin as you're referring to, Scott, with credit spreads, buying calls, using margin to buy calls or anything like that that can take 100% risk. If I was to use margin in your case, if we were going to consider that a margin issue, I would stick to the protected positions, okay? I would stick to married puts and collars, doing it that way, and wouldn't speculate with spreads, especially anything dangerous like a short straddle or a short strangle, where you have infinite risk in one direction or the other. You've got to be very cautious. I don't know the best way to answer that, and I don't want to put you in a position where you feel like you want to do that as well. Okay, Tony, you've been patient. I'm gonna answer your question in a minute, but Valan just followed up and said that collar has no place in investment to reduce cost basis, regular and stagnant or down market. Collar is a perfect, selling a call against a married put is the perfect thing to do in sort of a stagnant market. That's what I want. Okay, let me show you an example. I'm in a position now, don't think I'm gonna get a chance to show them, but I'm in a position now, two positions actually, that have moved up. These two got me. These two faked me out. I'm going to be honest with you. I was completely duped by these two positions. Everyone should be so lucky to be in a position. The married put on ALY, Ally Financial, got in original at 1970. I had purchased the 20 strike put and had a risk of about 5-6%. The stock moved up. I'm sorry, I sold a call when the stock was trading right around the same price, 1980, at the 20 strike, and that was in December, and it expired worthless. Okay, and then what ended up happening is earnings came out on Monday or Tuesday, and after earnings, the stock had a very minimal effect. It moved up to about 21.10, but stayed there. Okay, and so I thought to myself, well, the earnings looked great, but no one's reacting to them. So towards the end of the day, I waited after the initial thing, and I looked to later in the day to make a trade, rolled up the put, and then I sold the call, the February 20 call. This bulletproofed the position where I have no risk and had a max return at 6.5%. The stock gapped up another 50 cents, I think $1.10 the next day, outside of earnings, and then it went up another 80 cents. It's sitting at 22.71 now. So when the stock was trading here at about 20.50, maybe a little bit above, what was my expectation? The earnings didn't have as much pop as I thought. I sold the call, creating a collar, legging into the collar. And Valan, you had said that has no place in investment to recost basis regularly in stagnant or down market. When I entered this trade and saw this graph, that's exactly what I wanted. I wanted a stagnant to slightly down market. That is the best place to be, or slightly up, with this position. When you sell a call against the married put, you don't want the stock to go above the short call strike price. Okay, you really don't. You can let it go a little bit. I'm still in a very good profit zone here, percentage-wise for the position, mind you, not monetarily, but percentage-wise. I can't lose any money. Selling a call against a stock position, whether it's a covered call or inside a collar, is the most stagnant, neutral thing you can do. You want the stock to end right there. And even if you have a collar that's more pronounced, it looks like this, you want the stock to be right there. And on your covered call, you want the stock to be right there or above. Okay, so that's neutral to bullish in a covered call. But on these collars, I want the stock to be right there. I want it to be stagnant. Okay, and if it falls, well, then this expires. Okay, so let's say Ally now pulls back, and I'm not sure if it's going to, but let's say Ally pulls back to, that's an exaggeration, but let's say it pulls back to 20. Okay, drops another 10%. It's trading right at 20, and I'm holding this 21 put option. Would I sell a 20 call? I don't know. It'd have to be based on my cost basis. Because if it gaps back up again, I'm in the same position I'm in now. The question comes in, why haven't I rolled this yet? Well, because the option is $1.70 in the money with 14 days to go, and the market maker today wanted $2.50. I'm sorry. I'll give it the weekend. Even if it gaps up to $23.50, okay, even if this goes up to $23.50, he's asking for 80 cents of time premium to buy back that call right now for 14 days, which is twice the premium I collected. I'm going to wait for that time decay to work in my favor. I sold this call to get the time decay. That's what I'm going to look for. Okay? So I don't think I'm understanding your question, Valan, and I apologize for that. But yeah, when I sell a call, whether it's a collar, whether it's a covered call, this is a stagnant neutral. Absolutely. Valon said, is it wise to remove the covered call before earnings? Absolutely. I didn't sell the call on, the first call I sold on Ally was for December because no earnings were in that time and it expired. And then it was hovering around lower 19s for part of January before it started its move back up, and the earnings came out on January 23rd. So I waited till, or January 30th, 31st. So I waited for after the earnings to sell the call, but it turns out that was just the start of the rise. What am I likely going to do? I am likely going to close this call, and I'm going to move the put up from the 20 to probably the 23 or maybe the 24. If Monday this opens at 23.50, this put's going to be moved up to the 24. The call is going to be closed. I might sell a 24 call. I might just leave it open. Okay. AEIS is another one, but that's a different example. That risk-reward profile probably looks a little bit better than the Ally one. It is the same strike. But on this one, after earnings came out, the stock didn't move too much. My cost was $56.80. The stock's now trading at $61.70. After earnings, the stock moved up to about $59.40. It didn't move much at all, and it was positive, beat revenue, increased the next quarter, beat earnings estimates. It didn't move. So later in the day, when I felt it was safe that there wasn't going to be a late reaction, we sold the 60 call for $1. Yesterday, it went up 85 cents, then went up about another 40 cents the next day, 45 cents on Wednesday and Thursday. So here it is now at 61.70. So the Fusion subscribers, this is my real trade, it's actually in Fusion. Fusion subscribers asked, well, why haven't you rolled AEIS yet? The trick with AEIS is that it doesn't offer weekly options. It offers standards, which is fine. I've got a February call 14 days out, but it only offers 5 strike differences. And I knew this when I got into it, and I'm okay with it. So why am I not rolling now to the March 65 at 90 cents to $1 instead of leaving the 60 open? Well, it's because I'm going to get a better risk-reward profile and a risk-reward ratio if I even let the stock go up to, I need the stock to go up higher is what I'm saying. I need it to go up to about 63. Okay, buying this 60 back now and selling the 60 call that's in the money for March or selling the 65 makes no sense. It's going to be a wash, and I'm going to increase my risk on the position. So what I need to do, what I want to do, is if the stock goes up to 63, I'm going to put the 63 call in there real quick. We're just going to go ahead and submit that. I'll show you why in a reason. But if the stock goes up to 63, and then next week, let's say 2.8. Oops. Sorry, folks. The call that I sold is going to have an expected value of $3.17. Now, that's not right. It's going to be much higher. It's showing an expected value of $37. Right now, it's at $35. That's going to be much higher than that. But even though I'm paying $3.17 to buy it back, that's going to be mostly intrinsic, isn't it? I'm only giving up 17 cents a time value. Right now, with the stock at 61.70, again, the market maker wants about $2.50 for it, so he's asking for another 80 to 90 cents a time premium for 14 days, and I only got $1. So I want to see that time value. Even though it's intrinsic, I'm okay paying intrinsic back because I've made it on the stock. The stock's still there. I made it on the position. Okay? All right. Now, I'm going to give, Tony's been patient. I skewed off on 2 different things there in that case. So Tony's been very calm. I'm going to use AIES as an example. We're going to use current prices. The question is, can you contrast a covered call with buying a LEAPS call and selling OTM front month? Calendar spread versus covered call, sure. Are there any advantages and disadvantages? Yes. All right, your static covered call. And now let's use UBNT. UBNT has earnings coming up, so I don't want anyone to think that I don't want anyone to enter these positions. No. Let's just use Starbucks. I want something with better strike differences than the 5-point spread, and I don't want to use Ally because that's too low of a stock there. Good, right around $55, okay? So your standard covered call, depending on what you wanted to do. Now we're going to assume, I'm going to work on an assumption here, Tony. When you do a calendar spread, you really don't want it to get assigned, and I'll show you why in a moment. But based on that means you're going to be selling a slightly out of the money call for your 10, 14, 20, 30-day out short-term option. I'm going to do the same approach with the leaps. Now, I can use a leap for the calendar spread, but you don't have to. All right? It's often been taught that you have to use a leap, a year out or a 2-year out. It's okay to use the 130, 160, or 224. It's a farther term option. You're still getting the same kind of advantages of a leap, just not as much time. Okay? But let's use your leap. We're going to take a January, and I'm going to go about 10% in the money. I'm going to buy a 50-strike leap call, and we're going to buy it at 745. It's midpoint there. We got a 735 bid, 735 ask. Okay, so we'll buy one at 745. Now, at the same time, we're going to sell a near-term 56. I don't like to use the 55-50s, and it's right at 55. All right, we'll use the 55 against my better judgment. And we're going to sell the 55 call for that, was it 50? I'm sorry, folks, 34 cents, 33 cents, okay? Now, this doesn't look great on, this might not look great on paper, meaning that you're only reducing your risk by 33 cents. This is your risk. Whatever you have invested in the position, your leap is your risk. We're going to talk about it again. This is the lie of leverage. Okay, so here's, now, we're going to go out a month. I apologize, folks. We're going to go to March 10th, 35 days out. I need a little bit better premium. We're going to get 90 cents, 93 cents. No one would have entered that calendar spread as I just showed it. I don't think anyone's entering this one either. It's not good enough numbers using the leap. You get a better risk-reward ratio using a July. Okay? But here's the position. This is sometimes called the poor man's covered call. Why? Because instead of buying 100 shares of stock at 55.06, I bought one call at 7.45. Okay? So it's sometimes referred to as the poor man's covered call. I do not like that analogy because it is not correct. And you can see why just by the profit and loss charts. The only time I'd use the term poor man's covered call to describe a diagonal spread is if I was telling you that if set up incorrectly, it has a chance to make you poor quickly because you can lose in either direction, unlike a covered call. Remember, if I got into a covered call right now, did that same setup, well, with the current prices, of course, and we bought 100 shares of Starbucks at 55.06. I'm just putting this in on another screen. Don't worry, you'll see it in a second. And we sold our 35-day out March 10th call for 93 cents. We'd get a reasonable return. Let's take a look at that profit and loss chart, shall we? Well, it's a 1.6% return. This doesn't have as much volatility, but we'll just look at that now. But that's anywhere above 55. Okay? That's, you still make a profit. On the diagonal spreads, if it gaps up, you can lose, especially in the first or second right. Okay, what I mean by right, this is called the right cycle. We wrote once, we'll write another one. And our plan is to write continuously to lower this down. So the right cycles are how many times I can write this over the course now of the leap. This was 35 days out. Remember, this is 365 roughly days out. So essentially, under 365, we have 10 right cycles. I can write this option 10 times, which would give me $9 and look for a return. But that's not what you're going to do with a diagonal spread. You are not going to hold this leap for the next 12 months and continue to just sell the same call against it, collect 93 cents, so you take in $9.30 off a $7.45 investment, and you've made about a $2 profit against that investment, which would be a 33% return, roughly, over the course of 12 months. That's not what you're going to do. Because you're going to end up having to buy the short call back just as you would as a covered call to stay in the position. And if it's not structured properly, you can lose to the upside as well as the downside. Now, what is the other risk on the position? Here's my covered call, not a great covered call for 35 days of 1.6 return. I'd usually be around 2.8% goal. But let's say in the next 10 days, around February 14th, happy Valentine's Day, our stock falls 10%. Okay, so it drops down to $50 per share. We keep the 93 cents. We have a loss of $4.13 on the entire position, which of course is about an 8% loss. We hedge that by the 1.6% premium that we receive from the covered call, the 93 cents. Okay, so 10% drop equals about an 8% gain. Leverage, my friends, works both ways. A 10% drop on the stock in a diagonal spread, and a 10-day period 10% drop, you're looking at a loss of $216, half of the monetary amount I have in the covered call. But again, it's 30%. A 10% drop will usually result in a 35 to 45% decline or more in the option price. And remember, you're not invested in the stock. You're invested in the option. I'm going to be straightforward with you. The numbers I just pulled up, this is a terrible calendar spread and I would never enter it. This diagonal spread would never match my criteria. Why? The reason why this position shows that you can lose to the upside if the stock moves up is because it doesn't satisfy one simple rule that I always use for my diagonal spreads, and that is that the net debit has to be less than the difference in the strike prices. Okay? Why? Well, what do I have here? And this is another reason that you have to consider, you want to consider, Tony, when you're entering these positions, when you're looking at these leaps, okay, is that the leap you bought, this 50 option probably has a delta of around 0.56, maybe 0.6. Okay, somewhere there, 0.56 to 0.6. Short option delta is much lower right now. Okay, that's the trade-off. So where am I going with this? If the stock suddenly gapped up to 60, keep in mind I don't own the stock. I do have an obligation to deliver shares of stock at 55. My obligation to the option does not change whether I'm in a spread, a bear call spread. Anytime I sell a call, I have an obligation to deliver shares of stock if the stock's trading above that price. And if the stock is above that price, I can be assigned at any time. Doesn't always happen, but you have to remember you can be assigned at any time. So if the stock gaps up to 60 and I get assigned early, my broker says, oh, he doesn't own stock to deliver this 55 strike call he's got open, but he does have a 50 call, so we're going to exercise this because we have to cover ourselves. So we're going to buy shares for stock at him at 50 by exercising his long call, selling it immediately at 55, so I get $5 back. My investment was $6.52. I take a loss of $1.52. Whereas in the covered call, you would have had the gain of 1.6%. So this would never have matched my criteria because the debit has to be less than the difference in strike prices. So if it does gap up and I get assigned early, I still make out with a profit. So if that's the case, if the debit to strike difference here is less than, I'm sorry, if the net debit's greater than the strike difference, how can you ever profit? Well, you bought a leap. And as you get to expiration, as the stock moves up, you're gaining delta on the long option. Right? So we go to expiration. If the stock's trading at $55 per share, the short call strike price, our long call doesn't lose that much. We keep the 93-cent premium. It gave some back. It would be increasing too. But in this case, it shows that the long call would lose. I don't buy that. I think it would actually increase. It's being conservative here, this calculation. And we keep the 93 cents. We have a $70 profit. That's the max return based on the Black-Scholes pricing model for this position. Okay? But now what happens when the stock goes to 56? Well, the delta on my long option might be around 0.75, 0.70, but at expiration, this delta magically goes to 1. but you sold it, so it's -1. So if the stock goes to 56, you have to buy back this option for $1, and you probably only gained 75 more cents on this one from 55 to 56. If it goes up to 60, this is going to cost you $5 to buy back. This delta might be close to 0.85 or maybe even 0.9, but it's not at 1. So that's why this happens, because the short option goes to a delta of 1, which to you is a -1, and your long option is not there yet. Right? It's still probably around 0.75, 0.8, 0.85, somewhere in those ranges. Okay, so that's the trade-off there. That's why we start to see this loss, and you see the loss on both sides when you don't have, when the strike price, the strike difference is less than your initial net debit. So you'd have to set this up differently to make sure that your debit's less than the difference in strike prices. And Tony's last follow-up question, in relation to this here, and if I know we're a little bit past, if anyone has last-minute questions, you can go ahead and send those in. But he asked, in relation to the married put with a covered call, would you ever add a long put to the diagonal spread to protect it? No. This is an entirely different position from the beginning, so you're treating it a different way. This is a similar risk-reward profile as having a stock, the long-term put, and a short-term call. It sort of creates a synthetic calendar. If you add a put on this to protect the downside, you're going to completely kill the upside. It's not going to be a bullish trade anymore. It's not going to be a bearish trade. It's kind of a nothing trade. Let me show you. Let's say we go out now and we buy a July, let's say 60 put, $6. Well, we've created a bearish play. We've created the synthetic bear position, essentially, haven't we? $1,252 loss to the upside. If the stock continues to go, the total debit on the position. And then, of course, you make the profit to the downside. This isn't the trade you were going for. This profit and loss chart does not match protecting or ensuring the downside, okay, of the calendar spread. You'd look for a different approach in that case. Okay, if this was your sentiment, you thought the stock was going to fall that far, you'd look for a different one. All right. Okay, well, I'm going to navigate back over. That's all I wanted to share about that for today in relation to the comparison. The reason I say that is I don't have it written up yet, but I just want to remind everyone, those of you that are here, if you haven't done so yet, remember you can take a 14-day free trial of Power Options at any time. Just go to powerop.com/RAT. You can put in your first name and email address. You'll be able to take a 14-day free trial on the position. Of course, our subscription levels after that, we do offer an end-of-day service. It's missing some of the information there as far as the picks of the day access, search results by email, but it's only $40 per month. The most common, the delayed service, the 15-20-minute delayed service, is $60 per month. Of course, we do offer a real-time service as well, which is $120 per month, and we also offer back testing as well, which you can do also for the extra fee there. Okay. All right, I didn't see any other questions coming in. What I said a moment ago about what I'm going to cover today for the spreads, we're going to do a webinar on Wednesday just focused on calendar spreads for power options, just the basics, the structure, the setup, what to look for. Not really talking about management so much. We'll talk a little bit about it, but we're really going to talk about these things I mentioned with the diagonal spreads. Okay, the proper setup, the proper structure. Is it better to go further out or closer in depending on what your goals are and what your obligations are as well for your personal portfolio? We'll talk about that. That's going to be on Wednesday. And we'll have a couple radioactive trading presentations next week as well. If you do think of any questions later on, remember you can send me an email at any time to support@powerop.com or to support@radioactivetrading.com. Remember, you can always call us during market hours at 302-992-7971. For those of you that are trial subscribers, remember you can schedule a coaching session at any time.